is that they don't care about that. So let's dive a little bit deeper into the economics of a VC fund to better understand. A typical fund has a lifespan of about 10 years, during which they will invest in roughly 20 companies. And these are not hard and fast rules, but it's a good numerical example that is very typical. In such a company, in such a fund that invests in 20 companies, the expectation is that about 1/3 of the companies, so anywhere from 5 to 7 companies, will be complete losers. They will fail completely. All the money that you put in, you won't see anything back, or you will see pennies on the dollar. About 1/3 will break even. So you put in 5 million, you will return 5 million. You won't lose money, but you won't make money. And you will only make money on about 1/3 of the companies that are there. And for most of those, the return will be 2 to 5 times the money that the VC invested in. And there is always the hope that there will be one huge winner in that fund that will be a 10x return. And if that happens, that one unicorn, that one very successful company will return the entire fund. So if the fund was, let's say, $200 million, that one unicorn will return $200 million to the investor. The other thing that you need to realize is that VCs are not investing their personal money. They're investing the money of their limited partners. And these limited partners are expecting outsized returns in exchange for the risk that they're taking by investing in very risky companies. So a typical expectation is that a fund, to be a top VC fund, it needs to return 2.5 times the capital invested to its own limited partners in order for them to accept the risk. But this is net returns. In order to return 2.5x net, the gross returns need to be even bigger, because out of that money that the limited partners put in, management fees are paid annually. Typically, on 2% of the fund is paid every year to the managers, the VCs themselves. So over the lifetime of a fund, you can see this quickly comes up to about 20% of the fund. And in addition, the VCs, who are the general partners of the fund, also take a portion of the proceeds to themselves. This is how they make most of their money. So netting that out, the fund itself needs to return 4 times the money invested on a gross basis before it is considered a successful fund. So every single investment that they make needs to at least have the potential to be that home run, that unicorn that will return the entire fund. So if you've got a great idea and a good team and proven market fit and proven product market fit and good technology, but the overall opportunity is, say, for a company that will be a $20 million company down the road, that's not something that the VC would be interested in. It might be a great company for you personally, but this does not have the makings of a proper VC investment.